Are you truly prepared for the tax surprise that catches so many retirees completely off guard the moment they stop working? Hello, I'm Daniel Robert Whitmore. I spent 30 years working in financial services, and I've watched thousands of people make the same three mistakes in retirement. Mistakes that cost them tens of thousands of dollars in avoidable taxes. Here's the thing. You spent your whole working life saving. You did everything right. You maxed out your IRAs. You kept money in taxable accounts. You built something real. But the moment you retire, the tax game completely changes. And that's where most people stumble. Your tax bracket in retirement might actually be your lowest point in life. Think about that for a second. You're not earning a six-figure salary anymore. You're living on a combination of Social Security, whatever you withdraw from your retirement accounts, and maybe some investment income. That creates a window, sometimes a 5, 10, or 15-year window, where you can do things with your money that would be completely impossible during your working years. Most retirees have no idea this window exists, and by the time they realize it, it's too late. I want to walk you through 3 specific mistakes I see happen over and over again. These aren't theoretical problems. These are real situations, based on numbers that come from actual tax returns I've reviewed. Let me start with the first one, because it's probably the most valuable opportunity you'll ever have. Most of you have heard of capital gains rates. You know that long-term capital gains get special treatment. But here's what you probably don't know. In certain years of your retirement, you can take capital gains at 0% federal tax. 0, not a special rate. Not a deduction. 0. This only works in specific circumstances, but when it works, it's like finding money. Here's how it operates. The IRS lets you have some income before you hit the 12% regular tax bracket. For a married couple filing jointly in 2023, that number was roughly $89,250. That's your standard deduction plus some room. Within that space, you can realize capital gains and pay absolutely nothing in federal tax. Now, most retirees never use this. Why? Because they think all their income is being taxed, so they avoid selling anything. They sit on positions with enormous gains because they're afraid of the tax bill. This is the exact opposite of what should happen. Let me give you a realistic example. You and your spouse retired. You're living comfortably on about $120,000 a year. That's solid. But look at what you could actually do. You withdraw $30,000 from an IRA. Now, the standard deduction for a married couple over 65 is $30,700. That withdrawal is almost completely sheltered. You owe nothing on it. But now look at your brokerage account. You have positions with significant gains. Maybe you bought tech stocks 15 years ago. Maybe you bought index funds and never rebalanced. Whatever it is, you have gains. You could sell $90,000 of appreciated securities. 75% of that is long-term gains. We're talking about $67,500 in capital gains. And here's the crucial part. Almost all of that falls under that 0% threshold. You realize tens of thousands of dollars in gains, and your federal capital gains tax is 0. Why would you do this? Because now that appreciation is sitting in your taxable account as cash. You can spend it, move it, manage it. It's flexible. It's not locked away in a traditional IRA, where it's going to be forced out later, creating even bigger tax problems. The old way of thinking says, hold for the long term. Avoid taxes. The smarter way says, use this window deliberately. Harvest these gains while they're 0%. Reposition your portfolio, then move on. Most people never even consider this. Their advisors never mention it. So they miss a window that lasts 5, maybe 10 years. That's the difference between retiring with flexibility and retiring with a tax burden that never goes away. The second mistake is more subtle, but it's also more damaging. It's called the Social Security tax torpedo. And if you don't understand it, it can turn a single retirement decision into a cascading tax nightmare. Here's the mechanism. The IRS determines what portion of your Social Security becomes taxable based on something called provisional income. Provisional income is your adjusted gross income, plus certain other items, plus half of your Social Security. If you're a married couple and your provisional income is below $32,000, none of your Social Security is taxed, 0%. But once you cross $32,000, everything changes. Part of your Social Security becomes taxable. And once you get above $44,000 in provisional income, up to 85% of your Social Security can be taxed as regular income. This matters because of a phenomenon that people don't see coming. Let's say you're thinking about taking an IRA withdrawal in a given year. You're in the 12% bracket. You think, okay, I'll pay 12 cents on the dollar. That's the tax rate I'm in. Except you're not in the 12% bracket. Not really. That extra IRA withdrawal is going to push your provisional income higher, which means it's going to pull more of your Social Security into taxable income. Every dollar you withdraw could effectively cost you 22% in taxes, not 12%. The extra 10% is because you've triggered taxation of Social Security you were already receiving. I had a client, married, both collecting Social Security. They were living on about $80,000 a year and doing fine. But they needed some extra cash one year, so they withdrew $20,000 from a traditional IRA. They thought they'd pay 12% in tax on that withdrawal, $2,400. But their tax bill jumped by almost $4,500. Why? Because that IRA withdrawal pulled an additional $20,000 of their combined Social Security into taxable income. They weren't just paying 12% on the withdrawal. They were paying an additional tax burden on money they were already receiving. That's the tax torpedo. It's not obvious. It doesn't show up in your federal tax bracket, but it's absolutely real. This is why withdrawal strategy matters so much in retirement. You can't just pull money out randomly and hope it works out. You have to think about your Social Security, your overall income, and the interaction between them. One decision affects everything else. The third mistake comes down to timing. It's about conversions, moving money from traditional retirement accounts to Roth accounts, or about the timing of pension distributions and other withdrawals. And here's what makes this so tricky. You can make two opposite mistakes, and both of them will cost you money. The first mistake is underconverting. This happens when you're being too conservative. You're in retirement. You have these valley years, years where your income is lower than it's going to be later, when Social Security gets added on, or when required minimum distributions kick in at 73. During these valley years, your tax bracket is probably lower than it will ever be again. If you fail to convert enough to a Roth during these years, you're leaving real money on the table. You're passing up the opportunity to move money into a tax-free account while your marginal tax rate is low. Later, when you're forced to take distributions, or when Social Security is added, you'll be in a higher bracket. You'll wish you'd converted more when you had the chance. I've seen people leave hundreds of thousands of dollars in traditional IRAs when they could have moved it at a 12 or 22% rate. Instead, they end up taking forced distributions at 24 or 32%. They could have saved the difference, but they didn't because they weren't being intentional. But here's the other mistake, and it's just as real. Over-converting. This happens when you convert too aggressively, push yourself too far up the income ladder, and you end up paying more in taxes today than you would have paid later. You thought you were being smart, but you moved too much, too fast. Maybe you convert $150,000 when you should have converted $100,000. Now you've pushed yourself into a higher bracket. You've triggered higher Medicare premiums because of income-related premium adjustments. You've taxed too much of your Social Security. You've created a tax bill that was completely avoidable. It's a balancing act. You want to convert enough to take advantage of these valley years, but you want to be precise about it. You want to hit your target bracket and stop, not go over, not leave money on the table either. This requires planning. It requires knowing what your brackets are, knowing what your future forced distributions will look like, thinking about Social Security, and being intentional about every dollar you move. Most people never do this. Their CPA does their taxes, they file, they move on. But if you're serious about retirement, you need to be thinking 2, 3, 4 years ahead. You need to map out what your income will look like. You need to run the numbers and decide, what's the optimal conversion strategy? Let me be honest with you. The difference between getting these 3 things right and getting them wrong is substantial. We're talking about tens of thousands of dollars. For some people, it's much more. The 0% capital gains window might save you $5,000, $10,000, $15,000 or more in taxes, depending on how much appreciation you have. Avoiding the Social Security tax torpedo might save you $3,000 to $8,000 a year, every single year. And getting your conversion strategy right could mean the difference between a comfortable retirement and one where you're paying more taxes than you need to. These aren't things that happen by accident. They happen because you decide to be intentional about them. You're 62, maybe you're 63. You still have time. You can plan this. You can talk to someone who specializes in this kind of thing. You can model different scenarios. You can run the numbers and see what actually works for your specific situation. But you have to decide to do it. You can't just hope it works out. That's what I wanted to tell you today. These 3 mistakes are completely avoidable. You've already built the wealth. You've already made the hard part work. Don't leave money on the table now. Be intentional about your taxes in retirement. Plan for these windows. Use them, because once they're gone for good. I'm Daniel Robert Whitmore. Thank you for watching.